Welcome, fellow travelers. Welcome to the vast, deep, and often stormy ocean of finance. Take a look around. Most people spend their entire lives standing right there, on the shore. They watch the horizon. They dream of reaching that distant place we call the island of financial freedom. But they are terrified. They see the sharks. They hear the crashing waves. They stay on the sand because they don't have a map. Today, that changes. I am your navigator. My goal isn't to tell you exactly which ship to board. I am not here to sell you a ticket. Instead, I am going to hand you the binoculars. I am going to give you the blueprints. By the time we are done, you will be the one deciding which vessel is worth your gold. In the world of investing, you don't have to swim alone. In fact, you shouldn't. Instead, you use vehicles. We call them funds. Think of a fund as a massive, powerful vessel. Imagine thousands of people just like you pooling their gold together. Together, you hire the best crew. Together, you buy the sturdiest equipment. But here is the catch. Not all ships are built the same way. Some are slow, heavy, traditional galleons. Others are high-speed racers built for agility. And then, there are the mysterious stealth submarines. Those are reserved only for the elite. In this masterclass, we are going to deconstruct the 4 pillars of fund investing. We will look at mutual funds. We will look at index funds. We will explore ETFs and hedge funds. We are going to dive deep into their DNA. We will look at their hidden costs. And most importantly, we will see why the high-priced experts often lose to a simple, unthinking machine. By the end of this journey, you will have more clarity than 90% of retail investors. You will see the ocean differently. But before we set sail, a standard nautical warning. I am an educator. I am not a licensed financial advisor. This voyage is for informational purposes only. Investing involves risk. There is always the risk of your ship hitting a rock. Always do your own due diligence. Now, let's weigh anchor. To understand how a fund actually works, let's look at a simple analogy. We call it the single plank versus the whole ship. Imagine you have $1,000. That is your treasure. You decide you want to get into the water, so you spend all $1,000 on a single high-quality plank. Let's say this plank represents a single share of a famous company, like Tesla. Now, you are floating in the ocean on that one piece of wood. If the sun is shining and the wood is strong, you're fine. But what happens if Tesla has a bad year? What if the factory has a problem, or the wood starts to rot? You sink. Immediately. You are 100% exposed to that one company's drama. In the finance world, we call this concentration risk. It is the fastest way to lose everything in a storm. Now, let's look at a different way to sail. Imagine instead that you take your $1,000 and you find 999 other people. They all have $1,000 too. Suddenly, as a group, you aren't just a few people with planks. You are a collective with $1 million in gold. With $1 million, you don't just buy one type of wood. You build a massive, diversified hull. You use 500 different types of wood. Apple, Amazon, Microsoft, Exxon, and many more. Now, look at what happens when the waves hit. If that Tesla plank in your massive ship starts to rot, it doesn't really matter. Why? Because the other 499 planks are perfectly solid. The ship stays afloat. You keep moving. This is the power of diversification. A fund is simply a legal structure. It is a way for individual sailors to pool their capital together. It allows you to buy a basket of assets that you could never afford or manage by yourself. When you buy a share of a fund, you aren't just buying a stock. You are buying a certificate of ownership in that entire fleet. If the fleet grows in value, your share grows. If the fleet finds small treasures along the way, which we call dividends, you get your proportional cut. You are no longer a lonely person on a plank. You are a part owner of a navy. But the real question is, who is steering the ship? For over a century, if you wanted to venture into the deep waters of the market, there was only one way to do it. You boarded a mutual fund. Think of a mutual fund as a traditional galleon. It's a classic, heavy, impressive ship with a very specific way of operating. The first thing you'll notice on this ship is the person standing on the quarterdeck. This is the active captain, or the portfolio manager. This isn't just some random sailor. This is someone with an expensive degree from Harvard or Wharton. They have spent their entire life studying the currents. Their job is what we call active management. They don't just let the wind blow the ship wherever it wants. No, they try to outrun the wind. They spend all day in the cabin researching companies, talking to CEOs, and analyzing data. They are trying to beat the market. If the captain thinks technology is going to boom, they steer the entire ship toward tech stocks. If they smell a recession coming, they might panic and hide the ship's gold in cash or bonds. You are paying for their intuition. You are betting on their brain. But here is the reality of life at sea. A captain doesn't work for free, and neither does their crew. Mutual funds are expensive because of the cost of the crew. You have to pay for the analysts, the researchers, the marketing, and the captain's bonus. In the finance world, we call this the expense ratio. Typically, a mutual fund will charge you anywhere from 0.5% to 2.0% of your total investment every single year. Think about that. Even if the ship doesn't move an inch, even if the market stays perfectly flat, you still have to pay the crew. They take their cut of your gold before you ever see a profit. Now, let's talk about the harbor rules. In the world of mutual funds, you can't just jump off the ship whenever you feel like it. These ships follow a very strict schedule. You can only get on or off once a day. When the sun sets and the market closes at 4:00 p.m., the accountants come out. They calculate what is called the net asset value, or NAV. This is the total value of everything the ship owns, divided by the number of shares. That is the only time your trade happens. If you wake up at 10 a.m., see some terrifying news on the radio, and decide you want to sell your shares immediately, you can't. You have to put in your order and wait until the end of the day to see what price you actually get. You are locked in until the harbor master opens the gates. Finally, there is the barrier to entry. Many of these grand galleons aren't open to everyone. They often require a minimum investment. They might tell you, "I'm sorry, you can't board this vessel unless you have at least $3,000. For a beginner just starting with $50, these ships are often out of reach. So, who are mutual funds for? They are for the investors who truly believe that a human expert, a genius in a suit, can outsmart the entire ocean. They believe that by paying a higher fee, they are buying a better result. But as we are about to see, the ocean has a funny way of making even the smartest captains look like amateurs. In the 1970s, a man named Jack Bogle looked out at all those expensive galleons and their high-priced captains and said something revolutionary. He said, "Stop trying to find the needle, just buy the haystack." This simple idea gave birth to the index fund. If the mutual fund is a captained galleon, the index fund is an automated supertanker. It is massive, it is relentless, and it doesn't need a captain to think. Think of it as a ghost ship. On an index fund, there is no genius in a suit making guesses about which way the wind will blow. Instead, the ship is controlled by a preset map called an index. An index is really just a list. For example, the S&P 500 index is a list of the 500 largest, most successful companies in America. The index fund has one job, and only one job: copy that list perfectly. If a new company joins the list, the computer buys it. If a company fails and falls off the list, the computer sells it. This is what we call passive management. There is no ego. There is no strategy. There is only the map. Now, why is being mindless actually a superpower? It's because mindless is cheaper. Because you aren't paying for high-priced researchers or a captain's penthouse in Manhattan, the costs are microscopic. While a mutual fund might take 1% or 2% of your money, some index funds charge as little as 0.02%. That is nearly free. You aren't paying for expertise that may or may not work. You are simply paying for a computer to keep the ship on the tracks. There is a great performance irony here. You would think that a human captain would always be able to beat a computer, right? But history tells a very different story. The ocean is so chaotic and so unpredictable that most captains eventually crash or take a wrong turn. They get emotional, they get greedy, or they just get unlucky. The index fund doesn't try to be smart. It just stays the course. It accepts that it will never be the fastest ship in the harbor, but it guarantees it will never be the slowest. Over 10, 20, or 30 years, this boring strategy has historically outperformed almost every professional captain out there. However, the index fund still follows those old harbor rules. Just like the mutual fund, you generally only trade once a day at the closing price. These ships are built for long-term settlers, people who want to cross the entire ocean over several decades. Not for people who want to jump on and off every time a small wave hits. It's the ultimate set-it-and-forget-it vessel. But what if you want the efficiency of an index fund, but the speed of a racing boat? That's where our next vehicle comes in. ETF stands for Exchange Traded Fund. If an index fund is a massive, slow-turning tanker, an ETF is a high-speed powerboat. It has the same DNA as the index fund. It's usually tracking a list of companies, and it has been modified for extreme maneuverability. The killer feature here is real-time trading. Remember the harbor rules we discussed? For mutual funds and index funds, the gates only open once a day at sunset. You have to wait for the NAV to be calculated. But an ETF? An ETF lives on the open market, right alongside individual stocks. You can buy or sell an ETF any second the market is open. The price changes with every tick of the clock. If you see a massive opportunity at 10:05 a.m. and you want to sell at 10:15 a.m., you can. You have total control over the timing of your entry and exit. Then, there are the lower barriers. Traditional index funds often require a minimum investment of several $1,000s. That's a high wall to climb if you're just starting out. ETFs don't care how much gold you have. You can buy just one single share. If a share of an S&P 500 ETF, like VOO or SPY, is trading at $400, that is all you need to board the ship. In fact, many modern brokers now allow fractional shares. This means you can literally start your journey with as little as $1. It has democratized the ocean. We also have to talk about tax efficiency. Without getting too technical, the internal engine of an ETF is built differently. Because of the way shares are created and destroyed behind the scenes, they often trigger fewer taxes for you compared to a mutual fund. This makes them a favorite for people who are investing in taxable accounts rather than protected retirement accounts. You keep more of what you earn. But beware, there is a danger to speed. Because these powerboats are so easy to trade, many investors treat them like a game. They sit at their computers watching the price flicker. They see a 1% drop, they feel the adrenaline, and they panic sell. The powerboat is incredibly agile, but it is much easier to flip over if you are an emotional driver. The ghost ship tanker is hard to steer, but it's hard to sink. The powerboat requires discipline. So, we've covered the ships for the masses. Now it's time to look at the vessels that stay hidden in the shadows. Now, we leave the surface world behind. We are entering the deep, dark, and highly exclusive waters of the hedge fund. If the other ships we've discussed are open to anyone with a few dollars, hedge funds are the stealth submarines of the financial ocean. They are private, they are quiet, and they are reserved strictly for the accredited investor. People who already have millions in the bank or a massive annual income. These submarines carry aggressive weaponry that other ships aren't allowed to touch. Most ships only make a profit when the sun is out and the tide is rising. But a hedge fund can profit when the market is crashing. They use short selling, which is essentially betting that a company will fail. They also use leverage, borrowing massive amounts of money to amplify their bets. It's high octane, high risk, and designed to hedge against disaster or make a fortune when everyone else is losing. But life on a submarine is incredibly expensive. We call it the 2 and 20 tax. Most hedge funds charge a 2% annual management fee just for keeping the lights on. But then, they take 20% of all the profits they make for you. Imagine you make $1 million in profit. The crew keeps $200,000 for themselves. They are the most expensive crews in the world. There are also the lockup periods. You can't just climb out of a submarine in the middle of the ocean. When you give your money to a hedge fund, they often lock it away. You might not be allowed to touch your own gold for months or even years. They are high risk, high reward, and highly secretive. They aren't trying to track the market. They are trying to manipulate the ocean itself. But for the average sailor, these depths are often more dangerous than they are profitable. We've seen the fleet. But why does any of this matter? It matters because of a silent, invisible force called the compounding of costs. Let's look at the final scoreboard. Imagine two sailors, Alice and Bob. Both of them have worked hard and saved $100,000. Alice chooses the traditional route. She boards a mutual fund with an expensive captain and pays a 1.5% annual fee. Bob chooses the modern route. He boards an index fund with a 0.05% fee. Let's assume the market, the ocean itself, grows by 7% every year for 30 years. After 30 years, look at the treasure chests. Alice, after paying her crew their 1.5% every year, has a final return of 5.5%. Her $100,000 has grown to $498,000. Not bad, right? But look at Bob. After his tiny fee, he earns 6.95% annually. After 30 years, Bob has $761,000. The result? Bob has $263,000 more than Alice. Bob didn't work harder. He wasn't luckier. He didn't pick better stocks. He simply didn't let a captain take a massive cut of his treasure every single year. Alice paid over $250,000 for expertise that likely didn't even beat the market. For the vast majority of you, the index fund or the ETF is your best vessel. They are cheap. They are transparent. They allow you to own a piece of the entire world's economy for the price of a cup of coffee. Choose your ship wisely, stay on board through the storms, and let the tide of time do the heavy lifting for you.